You wake up one morning, check your phone, and see a rumour spreading. Your bank might be in trouble. Maybe someone on social media says they couldn't withdraw cash. Maybe a news outlet mentions liquidity concerns. At first, you shrug it off, but then more people start talking. Your friends or family say they've moved their money just in case. You open your banking app, and before you know it, you're transferring your savings too. This is the start of what's known as a bank run, and that's what we're going to look at in this video. Please do subscribe if you haven't already. It really helps this small channel grow. A bank run happens when too many people try to withdraw their money at the same time, and the bank simply doesn't have enough cash on hand to give it to them. Not because the money's vanished, but because that's not how banks actually work. When you deposit, say $1,000 into your account, the bank doesn't keep all $1,000 sitting in a vault somewhere waiting for you. In most countries, they're only legally required to keep a fraction in reserve. That's called fractional reserve banking. Say the reserve requirement is 10%. That means out of your $1,000 deposit, the bank only keeps $100 in cash or as electronic reserves with the central bank. The other $900 gets loaned out to someone buying a house, starting a business, or even to another bank. And when the bank lends that $900 to someone else and they deposit that money into their own account, the bank then keeps 10% or $90 and loans the rest out again. That's how new money is created in the system. Your original $1,000 ends up being multiplied several times through lending and redepositing, until it becomes several $1,000s circulating in the economy, even though the actual physical cash backing it might only be a fraction of the total. In the United States, this used to be controlled by something called the reserve ratio. For decades, it hovered around 10% for large banks. But in 2020, the Federal Reserve reduced that requirement to 0%. That doesn't mean banks keep nothing, they still maintain reserves based on risk and regulatory rules, but technically they no longer have a hard minimum. Instead, the system now relies on liquidity buffers and stress testing to keep things stable. So when everyone shows up at once wanting their deposits back, it's like 100 people all trying to pull chairs out from a table that only has 10. It's not that the bank is corrupt or broke, it's just that the system isn't built for panic. Banking runs on confidence, not cash. As long as people believe their money is safe, everything works. But the moment that belief cracks, it can collapse almost overnight, and sometimes the fear of losing your money is what actually makes you lose it. Bank runs are self-fulfilling prophecies. The most famous example is from the Great Depression. In the early 1930s, hundreds of American banks failed. People lined up in the streets, desperate to withdraw their savings before the bank shut down. At the time, there was no deposit insurance, so once the bank's doors closed, your money was gone. The panic spread fast. Neighbors saw others queuing and joined them, which only made things worse. That loss of trust nearly collapsed the entire financial system. Later on, the US created the FDIC, or the Federal Deposit Insurance Corporation, which guarantees deposits up to $250,000 per person per bank. In the UK, we have the FCSS, or Financial Services Compensation Scheme, protecting up to £85,000 per person per bank. The goal is psychological as much as it is financial. If you know your money's insured, you won't panic and rush to withdraw it, and the idea is to make people trust the system enough that the system never has to be tested. But even with insurance, bank runs still happen, like in 2007 at the start of the global financial crisis. When Northern Rock in the UK announced it needed emergency funding, people didn't care about the details. They saw the word bailout and assumed the worst. Within hours, massive queues formed outside branches, and £1 billion was withdrawn in just one day, the first true bank run in modern British history. The bank wasn't insolvent yet, but the run made sure it soon would be. That's how fragile confidence in banking really is. Then more recently, in 2023, Silicon Valley Bank collapsed after investors realized it had lost money on long-term bond investments. The bank's customers, mostly tech startups, didn't queue outside branches, they just opened an app and moved billions out in hours. It was arguably the fastest bank run in history. No shouting crowds, just fear spreading through group chats, tweets, and text messages. When a bank starts to fail, central banks can step in as the lender of last resort. That means they can inject emergency liquidity in the form of short-term loans that give the bank enough cash to handle withdrawals. It buys time, but it doesn't fix the underlying issue. If the bank's assets are truly worthless, bad loans, poor investments, or collapsed bond portfolios, no amount of liquidity can save it. And the real risk isn't just one bank failing, it's contagion. Once people see one collapse, they start wondering who's next. Because banks don't just hold your money, they lend to each other too. They're all connected by invisible wires of credit and trust. When one goes down, it can drag the others with it. That's why 2008 got so bad. The Lehman Brothers failure froze the entire global credit system. In today's world, social media has made bank runs faster and harder to stop. In the past, a rumour might have spread through a town over a few days. Now one tweet can reach millions in seconds. The Silicon Valley Bank collapse proved it. The system isn't built for that kind of speed. That's why banking at its core is a confidence game, not in the shady scammer sense, but literally built on confidence. Every time you deposit money, you're trusting that the system will honour it. That trust is what keeps everything functioning, and if you lose it, the system falls apart quite quickly. However, not every bank run ends in collapse. Sometimes central banks and governments act fast enough to stop it spreading. After the Silicon Valley Bank fell, the US government guaranteed all deposits, even those above the insured limit, and the panic stopped almost immediately. It showed the system can bend but not break if people still have belief the authorities will hold it together. So the next time you hear someone say the bank doesn't actually have your money, they're technically right, but that's not necessarily a bad thing. The system only works because it multiplies money through lending, but that's what fuels growth, mortgages, jobs, and investment. Do you think banks should be required to keep a larger amount of deposits in reserve, or would this harm economic growth? Let me know down in the comments, and please do subscribe if you've enjoyed this video, and thanks for watching.